Hello, my name is Brian Hirshberg. I'm a partner here in Mayer Brown's New York Capital Markets Group, and I'm going to be speaking today about direct listings. So in a direct listing, a private company chooses to list its common stock on a national securities exchange without undertaking an underwritten public offering of its securities at the time. Afterwards, the company becomes public and subject to all the usual reporting and corporate governance requirements in the United States, like any other public company. As we will detail later, the primary filing is to give effect to a direct listing without a capital raise component. This is called the resale registration statement. As I'll discuss later, the capital raise component has now been approved as of late last year. To provide more flexibility for issuers to raise capital. As most of us are familiar, the traditional IPO process includes a focused set of participants, and institutional buyers tend to feature prominently in the initial allocation of shares to be sold by the underwriting syndicate. However, in a direct listing, any prospective purchaser is able to place orders at whatever price they believe is appropriate, and those orders become part of the initial reference price setting process. The work and time required, however, to prepare the IPO registration statement and the resale registration statement that's required for a direct listing is very similar, and the disclosure requirements are substantially the same. The SEC comment and review process is also substantially the same. However, unlike a traditional typical IPO with usual safeguards, there is often more volatility associated with a direct listing. In a traditional IPO, there's a book building process that's conducted by the IPO underwriters alongside the management team. In the case of a direct listing, there's not a roadshow or designated underwriters to help build that book. Management will have the opportunity to express their views as part of an IPO process and in terms of the allocation of the IPO shares. That process doesn't play out in a direct listing. The company is, of course, not selling stock, so there's no book building process, but rather the shares that are currently held by its existing shareholders are simply resold into the market. Now, turning attention to the recent amendments, in December last year, both Nasdaq and the New York Stock Exchange received approval from the SEC to modify certain pricing limitations for companies that are undertaking a direct listing that involves a capital raise. For those less familiar, this is distinct from those direct listings that had been occurring for the last half decade or so now. Think Spotify and Slack and Coinbase. The SEC approved allowing capital raises with direct listings several years ago in 2020, but to date, no companies have chosen to do a direct listing with a concurrent capital raise. The exchanges have insisted that the reason for the lack of interest is simply due to the pricing constraints that were imposed when the initial rules were adopted. So as a result, the exchanges submitted multiple proposed amendments to the SEC over the past several years, trying to find a practical solution to this impediment. So now we have the agreed upon amendments that are designed to increase pricing flexibility and allow direct listings to be a more viable alternative going forward. Prior to the rule change, in order for a company to sell shares concurrently with a direct listing, the actual price had to be set at or above the lowest price range in the prospectus and at or below the highest price of the price range disclosed in the registration statement. Inherently, the lack of pricing flexibility was significantly less than in a traditional IPO or de-SPAC transaction and far too limiting, presenting a very high risk of a failed deal. The change modifies the pricing limitation to allow for trading so long as the actual price is set at or above the price that is 20% below the lowest price of the disclosed price range, or at or below the price that is 80% above the highest price in that disclosed price range. So the changes meaningfully reduce the risk of a failed deal due to unexpectedly low or high clearing prices. The price range is wider on the upside than the band often relied upon for pricing outside the range in IPOs, which typically spans 20% below on the low end and 20% above on the high end. In order to rely, the company is required to publicly disclose and certify to the exchange that the company doesn't expect the price change to materially change the company's previous disclosures in its registration statement. Additionally, the registration statement must contain a sensitivity analysis explaining how the company's plans would change if the actual offering proceeds are less than or exceed those which would have been received if the offering did price within the disclosed price range. As part of the change, the company needs to retain an underwriter with respect to the primary issuance and identify that underwriter in its registration statement. Notwithstanding the insistence that an underwriter be explicitly identified, there's still no actual underwriting commitment. And so this would be the distinct feature from what would be the case in a traditional IPO. The new underwriter requirement was designed to mitigate the SEC's concerns relating to the traceability and perceived lack of a gatekeeper, which were anticipated to arise in connection with a direct listing that had a concurrent capital raise. However, the perception of increased securities liability on that designated underwriter will likely increase the offering costs and potentially diminish the likelihood that the alternative will be pursued. The current practice for direct listings is to engage a financial advisor that would conduct the due diligence on the company. Requiring a bank to instead be named as an underwriter, of course, represents a major shift. So the details on how that shift will play out remain to be seen. As such, it'll be likely that the first company that does seek this new primary direct listing process while simultaneously registering shares for resale will need to obtain an SEC no action letter, which more clearly defines the range of activities that financial institution, which is named as an underwriter, can engage in on behalf of the issuer for that direct listing. To learn more, visit our free writings and perspectives blog. Thanks, everyone.